In this interview, I talked to Darren Camas, the CEO of IPOR Labs. Darren has a background of living all over the earth on multiple, I think, South America, North America, Europe, Asia. He is been in crypto since 2011. He's a senior advisor on Cardano and also an active angel investor and advisor on other projects. IPOR Labs is all about the derivatives market. So they're a B2B solution. They're trying to attract in institutional investors and companies even within crypto that want to manage the wealth of their assets in a more sophisticated way. We go deep into derivatives. He explains to me what a derivative is, how it exists in traditional finance, how it is going to exist, but doesn't quite yet in the crypto world, and where you can go beyond that as well. So for traders, people interested in trading, some of this you might know, but for people who are interested in trading and getting to know the opportunities within crypto and just how it all works, this is an awesome conversation. So I hope you enjoy. Here is Darren Camas. All right, Darren, just like that, we're live. I'd love to kick off this conversation just to get to know you a little more, what you were working on maybe before your current project, the IPOR. What was your pre-crypto career and interests?
Well, I don't really have too much of a pre-crypto career. So I actually started in crypto in 2011. So I'm actually calling in right now from Colorado, which is where I'm from. I grew up in the middle of the mountains. But I actually left the U.S. in the middle, in the financial crisis. So 2009, I was working in, luxury real estate and property management. And I ended up having a lot of friends from South America, right? And so, in Southern Hemisphere in their winter, when kids are on college, in summer when they're on college break, in North American winter. So you had a lot of people coming to the ski resorts, had a lot of friends. So I ended up, picking up and moving off to Chile. Fast forward a couple of years, I spent a little time as a professional poker player. And then I met this group of expats at a barbecue, and they were like, we're starting a Bitcoin exchange. And this was in June 2011. And I said, what's Bitcoin? And, I got a funny explanation. It's like crypto anarchy, peer-to-peer BitTorrent for money. And I thought at that point, I had no idea what they were talking about. Went down the rabbit hole, spent a weekend digging in, and I'm like, guys, I don't understand it all, but I'm in. And, let's say now here 11 years later, I've gone through many different ways and explanations of how to explain Bitcoin. And, at the time it was maybe the worst explanation, and coming back to it, maybe it's the best. So, I like the kind of first definition.
What's your definition?
Well, I mean, I like that, a P2P crypto anarchy BitTorrent for money one. It's, it started out as a very terrible one, and then it's turning to be, kind of maybe the most precise one. So, so I've been in crypto for about 11 years, on the exchange side and brokerage side. We used to be the number 2 to MTGOX back in the day. I was an advisor to Cardano. I did some stuff in security tokens for the past couple of years preceding IPOR, and now doing IPOR, which is, let's say, deep DeFi. It's DeFi interest rate derivatives.
And how did you progress? I'm curious to learn how you came at this from not a technical background. How did you progress through the technical hills and valleys? Did you take a conscious effort to go deep and understand the technology, or do you think about your expertise as being more strategic and high level, understanding what different projects do and how they interconnect?
Yeah, I would say, from a broad scale, I'm a, very high level thinker, and more strategic, macro view. But, at that time, if we think about 2011, there were maybe 10,000 people in the world that were talking about Bitcoin or crypto, which was only Bitcoin at that time, right? And because of this, you have a very restricted kind of set of materials. You have a very restricted set of, of educational pieces, and you really have to self-educate. So, the first years were really just deep dives, self-education, reading front to back, different, of course, the Bitcoin white paper, different technical papers, going through the forums. There was Bitcoin Talk at the time, which is where you could track all crypto projects and really, follow some of the great thinkers, read the primary resources, right? And so I don't come from a computer science background, but I have a good enough understanding of how things work so that I can understand, let's say, that we want to build like a project like IPOR, the feasibility, the different engineering trade-offs, and this is a result of, let's say, 11 years now of self-education. So.
And what did you see? Was there an intersection of maybe a convergence of different projects or some trend that you saw where you felt like IPOR being, I think of it, it's kind of one of the more complex to describe projects when I was doing research on it, but deep into derivatives markets. Yeah. How did you sort of realize that this was an exciting project to dive into?
Yeah. So, in my career, I've worked with some really, really talented people, and we've actually been at a lot of times very much too early for things. So we're looking at, maybe a decentralized audit protocol with a foundation, back in 2014. We're looking at setting up at the same time, an exchange traded product, which had, a basket of cryptocurrencies, which at that time, most of the currencies from 2014 wouldn't be around, but it would be very heavy, let's say Bitcoin, Ethereum, and Litecoin. Right. So we have a lot of these projects that were probably too early. And, a lot of these things come, much later on. Even in 2015, I started a payment company called BitNexo. We were doing essentially using the Bitcoin blockchain to, do wire transfer or replace the wire transfer system between, Latin America and Asia, particularly Chile, Mexico, and China. Right. So a lot of these things, were very early on, and maybe the ecosystem wasn't developed enough. So if we fast forward to, let's say, 2020, I'm in love with DeFi because you have these consumer ready applications, that are friendly enough that your average person can use it, right? And so, if we take let's say a fundamental breakdown of DeFi projects and, considering the current market meltdown, it's a good time to look at fundamentals. There's you have to go with, does this create some economic value, right? And it really boiled down, myself and Dimitri, my co-founder, we're really taking a deep dive at the end of DeFi summer and saying, okay, so there's really just fundamental value in DEX and lending, right? There's some economic mechanism. Someone's paying to borrow and they're paying back to the lender. Or in DEX, you have some exchange traded volume and some basis points, that go, some fee structure, right? And both of those have these primary market mechanisms, and then both of them have the derivatives that underpin these markets, right? And so if we look around, on the asset exchange side, from the centralized version to the decentralized version, what's going to happen. So we know on the centralized version, everyone wants to be, the next BitMEX or Binance or FTX, decentralized, and really DYDX is taking the cake on this currently, right? But very few people look at the credit markets and understand, how it works. And so also part in my career, we're doing actually risk recruiting, so that's how I got my feet wet in, hiring for risk managers. And at that time, it was around the time of the Libor scandal. And so the Libor scandal, in brief is that, you essentially ask, these 16 London banks what the interest rate should be. And then you do a survey mechanism and then you print it. And that's the basis for hundreds of trillions of deals, right?
Where did the banks get their where did the banks get the data from?
The banks would say, it's off their own books, right? So the Libor, the London Interbank Offered Rate, was meant to be, let's say, a free market benchmark rate separate from, the Fed or the central banking rates, right? So it tells you, what the banks are willing to lend to each other, versus what the Federal Reserve or the Bank of England sets, right? Yeah. The problem was it was being manipulated by the traders. Someone will whisper to another, say, hey, Mike, let's shave a basis point off here. Let's take the opposite side. Let's net a couple $1 million and put it in our pocket, right?
The banks were doing that.
Traders inside the banks. This is known as the largest rate fixing scandal in history. And that set off about a 8-year, cessation of the Libor. But, what we get from that is, a benchmark interest rate is quite good. It's quite useful because it gives the market transparency. It gives the market a basis to create different products, anywhere from if you take a home loan and they ask you, do you want to pay the, fixed or floating or, fixed or variable rate mortgage, right? Well, you have a choice. You're taking a chance that the rate might go up or down, or you can pay some fixed rate. But they're always going to give you a fixed rate at a higher rate than the variable or the floating. Mm-hmm. Why? Because there's some instrument on the back end that's kind of pegging that debt cost in place. So in the home loan example, you get two things, right? So one, the initial price is being quoted off a benchmark rate, right? So people will quote, or would quote LIBOR plus 50 basis points, for example. Right. And the other,
this would be a quote like a bank would quote a consumer who's trying to buy a house.
Exactly.
The markup for the bank. Right.
Yeah, exactly. And then on the other side, you have some interest rate derivative that the bank is using to hedge their risk. So essentially, they offer the credit product. They take a hedge and then they fix some spread, and that's how you get your fixed rate mortgage, right? So then if we look at DeFi protocols, these are very short-term debt, right? It's free floating. It has crazy volatility, and it's really nice. It's really interesting. It's really useful because, you can use it permissionlessly. You just have to post collateral and you can borrow, right? But it's really not useful for larger loans, because you have this extreme rate risk. We had seen some, the rates on these money markets like Aave or Compound go from like 3% to 30% in a 24-hour period.
Well, also,
right?
In addition to that, I mean, isn't the core existential problem with these market makers the fact that you have to put collateral nearly equal to the amount of loans? Like if I'm taking out $1 million loan for a house, I don't put up $1 million to take out $1 million loan. Which is,
actually, even in crypto, it's worse. You put up $1.5 million to get $1 million, right?
Right, exactly.
But one of the reasons that this exists in crypto is because if you do the partially collateralized, you have the technological capacity to potentially infinitely rehypothecate, right? So if I put down, let's say the million, right? So if you put down $200K to borrow 200K worth of ETH to borrow $1 million, you can go buy $1 million worth of ETH. To put down, $5 million to buy five, and this has this potential issue. So one of the reasons that you have this over-collateralization mechanism in DeFi is because you have this, rehypothecation risk. So
is the way that the traditional banking system gets around this is through communication between banks. So if I go and I take a loan out from a bank, that's going to be recorded on my credit bureau legacy. So the bank will be able to look it up and say, does this person have outstanding debt? Yeah. And it's like logged centrally.
Yeah. You essentially have the, let's say the risk profile, and you also have the ability to collect, right? So, if a bank is is giving you an extremely risky loan and you have a low probability to pay it off, then, it's a problem with their books, and it's a more systemic problem. Plus, they have the ability to enforce, on legal contracts, let's say with local law enforcement. So let's say it's a different set, right? But, of course, that way is much more capital efficient than, this over-collateralized DeFi mechanism. So you get all these different trade-offs. DeFi is really open, especially if you're a whale and you can borrow against your collateral. We can see that, like, if you're as a startup founder, let's say, you have a lot of equity and let's say you're equity rich, cash poor, you can do securities lending. You can, lend against your shares and get some cash flow. And you can also maybe, avoid a capital gains action, right?
Is that available today, right now?
Yeah. I mean, it's how a lot of, like startup founders, let's say pre-IPO or even IPO, they can get some liquidity, without having to pay, the capital gains from selling the asset, and it actually, creates a debt. But, that's only available for high net worth, and, it's not really accessible for the average person, right? Again,
is this like sorry to interrupt you. Is this like a secondhand marketplace, or where Because I thought about that, but I hadn't seen other founders or heard about this before.
Yeah, I mean, it's a fairly, standard practice, securities lending, to get liquidity. If you have it, it's, I think, what's his name? The Mavericks, Mark Cuban. He was tweeting about it. What's similar, between, let's say DeFi and securities lending, or, he puts up some other asset as collateral and can borrow against it, which is great, but you have this long approval process, you have this long paperwork process, whereas in DeFi, you post the asset to a smart contract and you borrow against it instantly. So he's saying, in that case, I think he's arguing that the barrier to entry is much lower in DeFi, as long as you have the assets, of course.
And is there a site that you're aware of that people are doing this, or is it through private security lenders?
I'm not. I'm guessing, most brokers can help with that, but I'm not familiar with a particular site, specifically for security.
Yeah, just curious.
Yeah, I'm all in on the crypto side and the DeFi side. So,
well, I don't see any reason that really structurally why you couldn't have that be a crypto concept. Like, hey, if I own, securities for a company, as long as I can validate that I own it with the company, then you might there's nothing stopping you from taking a loan out in crypto for that, right?
Yeah, for sure. And I mean, even like, let's say the creation of like pre-IPO marketplaces is quite similar, So if you look at like a DCG, right, Barry Silbert, his background, he started a company called Second Market, which I believe is doing, Facebook pre-IPO share sales. It's taking the options and the shares documents and then creating a secondary market, before it's public. Mm-hmm. So there's a lot of different ways that you can do this.
Yeah. Obviously, a lot of the regulations present creative constraints, we'll call them, between securities around.
Of course.
So from this industry or this landscape you're laying out, derivatives, what is a derivative? How do you define it?
So a derivative is something that gets us value from something else. So for example, in IPOR, what we're doing is we're creating this, let's call it not a synthetic LIBOR, let's call it like a, algorithmic LIBOR for DeFi. So if we take that going back to, the London banks talking to one another and presenting, say, okay, so this is our interbank lending rate, for today, 1 month from now, 3 months from now, 6 months from now, 1 year, for example. We can do the same thing from smart contracts. So we survey not banks, but protocols. So right now we're just tapping into the smart contracts of Aave, the smart contracts of Compound, and surveying those. And the good thing about those is they can't over or under report by a basis point. They're open, they're transparent, they're auditable. So we get this like real-time transparency from the blockchain that you don't necessarily get from, centralized financial services. And so what we do is we take that and put it into a benchmark weight, a benchmark rate, and then we have this backend component, and then we print to chain every so often because of Ethereum gas fees. So you get this on-chain IPOR rate or interprotocol offered rate, or you can also refer to it as the interprotocol overblock rate because we're sourcing it block over block, on the Ethereum blockchain. And, okay, so what's a derivative? So a derivative, the first derivative that we've built is called is an IPOR interest rate swap. So an interest rate swap is a very standard, financial instrument. You have two parties that are exchanging cash flows. They're exchanging the fixed rate and the floating rate. And so what we do is we actually take that and we create essentially derivatives DEX. So instead of those two parties, we take kind of the best of DeFi. So one of the parties is always a passive liquidity provider. So these might be a depositor who has USDC, USDT, or DAI, and they're essentially offering a request for a quote. They're offering a quote against a trader to trade. So this derivative, as the IPOR rate moves up or down, depending on what your fixed rate is, you're either paying or receiving against the pool. So this derivative instrument means that you're essentially just creating a market where you can go long or short against the interest rate. So as the interest rate moves up or down, it changes the payoff liabilities for one of the contract parties. So that means this derivative instrument is pegged to the movement of the IPOR index, either positive or negative.
Okay. So you are basically scraping compounded Aave, and you're looking at what the 1 year, 6 month, various time increment rates are. And then you lost me a little bit in the middle there. So from that point, what's the next step?
Yeah. Okay. So we're just getting a spot rate. Why? Because we don't really have these long maturities. We don't have term structures in DeFi.
Right. Okay.
And that's a problem, but it's also an opportunity, right? So we essentially take a spot rate and we create a market, right? The market is essentially, let's say you and I are want to enter into a swap. You think it's going to go up. I think it's going to go down. Okay. So we enter it in at a certain rate, right? So as it goes up, I'm paying you. If it goes down, then you're paying me, for example, right? And over all of these time periods where you were paying each other back and forth, once we close the contract, we settle the difference, right? So this is an instrument where we're just betting on the direction of the rate.
Of the interest rate.
Yeah, of the interest rate movement itself. So, for example, let's say, you typically want to be a pay fixed if you're a borrower, right? Let's say you take a loan at 2%. At 2% is great, but if it's up to 3%, it actually increases your borrowing cost by 50%, right? So why would you take a pay fixed? Because in the case that the rate goes up, then you're winning from the contract, and you're able to use that extra winning to pay off, the extra payment liability. On the flip side, if you're a lender, you don't want the rate to go down because then you're losing, a portion of your income. So these parties are usually at the opposite sides of a swap.
All right. So in the case like a use case, say somebody has take $1,000 and they are willing to lend that money in exchange for an interest rate. The standard way would be you just put it on Aave, and then there's a rate that's quoted to you, and you could deposit it into Aave smart contracts, and you're getting a return into the wallet over time based on whatever that rate is, and that rate changes, so it can go up and down. And then a derivative it's a derivative of that. So if you're not interested in strictly the interest rate, you're interested in the change of the interest rate. Yeah. And the reason you'd be interested in that, the types of people interested in derivatives, this is where I'd like to learn a little bit more. So who's typically when you buy a derivative, you're like you said, you're making these transactions between people who believe the rate's going to go up versus down.
Yeah, so there's really, let's call them like 3 typecasts, right? So the first one is the risk management side, and that's hedging, right? So again, borrower doesn't want the rate to go up, while the lender doesn't want the rate to go down, right? So the hedge is just you insulate yourself against the rate risk movement. So either you're insulating yourself against a move up or a move down.
I see.
The other side might be an arbitrage play. For example, if you can find a marketplace where you can borrow it cheap, where you have this kind of like divergence from the IPOR rate, and you can lend it, more expensive, then you can lock in those gains, right? Because those will typically revert to the norm. So if you have kind of these outlier rates, then you can, let's say, milk this rate, or you can lock in the difference, between two markets by taking opposite contracts, right? So let's say, the IPOR rate on DAI is, okay. So let's say, IPOR rate is, on DAI is 1% it's 2%. You can borrow it for 1%. You borrow it, you take a pay fixed loan, and then you find this outlier market where USDT is at 3%, but you can loan it at 4%, right? So you flip the DAI to the USDT, you take a receive fix on the USDT, and you're essentially milking this let's call it risk-free arbitrage. Depending on how you define risk-free, it's risk-free between stable coins, assuming that all stable coins are 1, which is $1, which is it's another piece. But that's an example of an arbitrage play. And then finally, you can just take a directional bet. So if you think the rate's going to go up, you go long. If you think it's going to go short, you go short. Or it's going to go down, you go short.
And so to make that simple example, that last one, if you think the rate's going to go up, you take the long. Or sorry, if you think the rate's going to go up, you would take. You would take a pay fixed. Pay fixed. And what would that look like if I'm going to take a pay fixed? That means I come in with USDT and I deposit it? Like what would that mean to make a pay fixed long bet on a derivative?
Okay, so let me walk really quick through the instrument, right? So there's two parts in this. There's the liquidity provider, which is essentially underwriting the instrument, and then there's the trader, right? So if you're a liquidity provider, you either post one of the different stablecoins. So there's an IPOR rate for DAI, USDT, and USDC. So let's use the USDC pool for an example. So let's say I'm a passive participant. I deposit USDC to the pool. So my USDC is sitting there. It's it's there to take contracts, right? And this automated market maker is essentially a pricing mechanism. So no matter what the rate is, it's going to take the position. It's going to take some conditions in the market, and it's going to say, "Hey, Mike, at this point, if you want to take a pay fixed, you take it at this rate. If you want to take it a receive fixed, you take it at this rate." So if you want to take that contract, you will open a contract with USDC, which is it'll take some USDC collateral, post it against my collateral that I've put in, and then that will be locked in the contract. And then at the end, that will be paid out.
Mm. And that currently is available for withdrawal at any time. You can end the contract at any point.
Yeah. So, we wanted to essentially create an instrument that matches this market, right? So if we look at a lot of traditional finance, you have a set maturity. You have something like European options, or which cannot, they have to, go to the, they end at maturity, right? But if you take more of like an American style option or a cancelable contract, you can open and close it at any time, right? So what we created first is a 28-day cancelable swap. So what does that mean? It means that, for example, you're the trader. You come in, you can open this contract, and you can close it at any time, right? And so you can cut your loss. You can lock in your profit, and then if it reaches maturity, either you can close it yourself or it can be closed by a decentralized liquidator. Mm. But yes, it's a 28-day cancelable swap. So we designed it as a way to to match the compound markets, which are extremely liquid, very short term. Yeah. And, you mentioned the longer maturities, or let's say the IPOR rates, the 1 month, 3 month rates. We're just not there yet. But, as we have a term structure mature, then we'll start offering longer contracts. And, this is how you start to build a yield curve in DeFi.
Of the users you have, how many of them, if you had to guess, are professional crypto traders who are spending the majority of their working hours in front of terminals and thinking about these kind of things, versus just the average person who's coming in and making a trade?
Okay, so one caveat. Right now we're on Rinkeby public testnet. Okay. So we haven't launched on main yet. We're looking at that probably in the next few months. It's just pending a smart contract audit. For what we hypothesize for the users, and this is also validated some by kind of our investor set, and some of the conversations that we had. For example, I was just a consensus is that these are it's an institutional product. Right. So institutions use it, let's say on large, loan books to manage risk. So this is why you don't have a lot of people who are looking and say, I'm going to go trade interest rate swaps today, because it's just not, let's say, a sexy retail instrument where, you can go gig along on the rate because you think that, the rate's going to, make you rich or moon, for example. But you do use it to essentially manage risk. And that's what we wanted to do. We wanted to create this stabilizing function, for the DeFi credit markets. So if we look at what's happening in the market right now, we have a lot of, large institutions, which, they have a lot of risk in the markets. And, so for example, if you have rate exposure, you have, different ways that you need to mitigate either your, this is asset liability management. This is an entire function inside of a bank, right? And so we believe that a lot of the, first of the, kind of the crypto CeFi native companies will be using this because they have a lot of exposure to DeFi. We know that, for example, with some of the tagged wallets from Celsius, that they have huge exposure to DeFi. And one of the things that we're seeing right now is that there's a lot of difficulties with the risk management procedures, and some of that is because these tools don't exist. And this is one of the reasons that we're building this. It's more of the stabilizing function, for the DeFi credit markets.
And so your thought is that this sort of more sophisticated trading market tool using derivatives will attract larger, more institutional investors into crypto.
Yeah, I think that's what we're hoping for, right? Mm-hmm. Because it's not a very hypey project. We're looking at building something that has, a couple different pieces, right? The IPOR rate, it can take a life of its own, right? So what our goal with this is that in the future it's run by decentralized governance. It's pulling in from a lot of different money markets. You have a lot of different independent calculators that are making sure that this is, to keep the sanctity of the rates, and then it lives on chain. So for example, if you want to just query the IPOR Oracle contract to set your credit market, to set your, you want to offer car loans using the IPOR rates, then you can just query that smart contract. It's a public good that lives on chain, and this is something that can take, a life of its own. And then we hope that, these different sets of interest rate derivatives, like the interest rate swap, we're looking at building interest rate futures, AMM, potentially swaptions book. These will be larger structured products. So, for example, if you're a DeFi bank, maybe, down the road, you're offering a car loan. That's one that's querying, to the IPOR Oracle, and it's taking an IPOR interest rate derivative. But for the end consumer, it's something invisible. Like all you see on an interface is a fixed rate. You can choose between a fixed rate and a floating rate. And underpinning all of that are these tools that we built. But it's not necessary for you to know about them. So I would say, the tools are much more institutional, but the applications are for retail.
Mm. And the key point there about the asset liability management, this is going to be the same, philosophically, it's the same practices and principles that centralized finance would be thinking about, right? We're not changing how, all these things are just duplicated on chain, right? So
but the thing is, you get better transparency, right? So one of the things I tweeted out recently. So this is about right now we're in a pretty big market meltdown. We've had the collapse of a couple big projects, protocols, and potentially some central entities. But the reason that we can see some of these happen is because a lot of it is happening on chain. Right, so we can see, let's say, these large loan positions, and we can look at the Aave books, we can look at the average liquidation price, and this is all transparent, right? So this is something that's actually quite amazing, right? The people that are trading this, they all have the same knowledge. They can all look at, the Ethereum blockchain, they can look at Aave, they can see, this large debt position, understand, what the liquidation price is, and they can act accordingly, right? That's a huge amount of transparency that we don't get from CeFi institutions. So this is really cool, and this is why we wanted to build something that is only focused on DeFi, because you get that transparency. Like we could build a rate that is, for example, pulling from the CeFi lenders. We can query and trust BlockFi, Nexo, Celsius, Genesis, but we don't have a view into their lending books. They could self-report it, but then it's no different than the Libor, right? So we build this kind of on-chain rate because you get this amazing open data with DeFi, and this open data with DeFi, even in this meltdown, the thing that I think is amazing is that you can actually make judgments based on what's transparently happening on chain. Mm. So that's really cool. And
what do you think of? Do you see maybe the first phase of this being companies like BlockFi, Nexo, Celsius? I mean, Celsius, I want to talk to you about in a second, but do you see these crypto first CeFi companies using a tool like this to basically manage wealth liability better?
Yeah, I would hope so.
Yeah,
I would hope so. I mean, this is, the riskier your behavior is, the more you're essentially playing with client funds, right? So, and this is maybe, the risk-taking behavior is it doesn't line up. Like what the most important function of a bank is the risk management, right? And so, yeah, I would hope so. You have different things, you have different products out there. You have that, you have to rely on this kind of internal treasury. You have to, you have to believe without this transparency. And, that's kind of the crypto ethos is, it's don't trust, verify, right?
Yeah. And it seems like I'm curious to ask you what your thoughts are on speculative, probably, on the Celsius situation. Just to frame it, though, first, these companies operate with the premise that you deposit your crypto into their managed accounts, and in exchange for that, you have functionality. You can quickly send a wire transfer to your bank. You can gain interest on the deposits that you have. They have different features, like you can deposit and commit or stake for 6 months or a year, and they'll pay you a higher interest rate for that. They have an exchange to swap back and forth. So, and they also are very easy to use. So there's a lot of functionality. I heard the number of 1.7 million accounts that Celsius had. Do you have a feeling or intuition or knowledge or thoughts on what they were potentially doing that was that bit them so hard? I mean, as of today, June 15th, they've closed trading, withdrawals, swaps. And they seem to be in a really rocky place, which is a precarious situation because their CEO only a few days ago was like, no one's having any issues withdrawing. Everything's fine. I don't know. Yeah.
Well, I mean, first of all, I will only, speak to what I know. The second is, we actually do share, a common investor in Gumi cryptos. But, some things that are known is, they have a lot of wallets that have been some of the most active wallets in DeFi. So there was this mystical 0xB1 wallet, which was theirs. So we know that they did get hit pretty hard in a hack, with Badger DAO. So it lost a significant portion of funds, but they were also able to raise a significant equity round after that. So I think their last raise was around 400 million, right? So as far as I understand in this current context, in the case of a bank run, you have to have access to your client funds. And so, for example, one of the big talks is about the staked ETH depegging, right? And so, what is staked ETH? So, staked ETH was, I can't remember when, but over a year ago, you could put in, you could lock your Ethereum, start earning, staking rewards on, the Ethereum version 2. But the question is, you cannot get access to those until, this switch to proof of stake goes live, right? So you essentially have this kind of locking function, where you don't have access to these funds, right? So it's locked. And then there's a secondary mechanism which trades staked ETH for ETH, right? So you can also become liquid in that, but it's also a derivative instrument, right? Mm. So if you lock too much Ethereum and then your customers come and ask for the Ethereum, well, you can't necessarily get it back. And then maybe if you need to get it, you have to trade your staked ETH for ETH at a discount. And so this is what's going behind the depegging. Another thing is, this particular wallet is being loaded up with, a lot of assets to make sure that their credit market, or their DeFi money market positions don't get liquidated, right? So it's pushing down the liquidation price, right? So it's essentially maintaining that overcollateralization ratio. But this is also kind of a game of chicken and mouse because, there's likely, one or several large firms that are on the other side of this trade that are essentially trying to, liquidate, these different entities because, they can also stand a profit. So this is, it's a very, let's say, precarious game right now. And it's coming off of, let's say, the unwinding or the complete collapse of Terra. With the macro view, with the 75 point, BPS hike today is, everything's looking quite dreary, right? So you have these also, macro events, large centralized institutions that, are on the risk of or have, essentially melted down or got liquidated or margin called. And, then you have this, these cascading, prices. But, central entity is different from DeFi, right? So it's a centralized entity. If you're looking at a bank, it has so many different products that it essentially it matches and let's say de-risks one product against the other, right? And so a centralized entity can typically offer, let's say higher yields than let's say a decentralized entity. So if you look at on the lending book, you have different credit products, you have trading products, you have spot. And you can essentially, cut margins on all sides of those and potentially offer, a higher return. Whereas in a DeFi protocol, look at Aave, it's just taking one product for another. You lend the ETH, or you stake, you post your collateral and you borrow, right? And there's a single instrument, and so they have to cut wide spreads on that because it's a single product. This is why it's very difficult in payments to compete with a bank, because a bank can always keep their spreads extremely low because, payments is one of their, revenue sources. But for a payments company, it's the only revenue source.
And would you also say that for a traditional bank, the competitive advantage that they have is the ability to go to the government and get a loan default enforced?
Absolutely.
Absolutely. Yeah. So I'm thinking, okay, what's the spectrum here for Celsius? They are, worst case scenario, they're doing what? They're trading everyone's money however they want, really completely up to them, speculatively, without any guidelines. I mean, what does it look like to have good versus bad wealth management for these companies, do you think?
I mean, first is transparency, right? I mean, there's reasons for regulatory, that you segregate operational and customer funds, right? This is something that's huge from the regulatory because, you don't want to commingle these accounts, right? So first is transparency. And the second one is actually, so if you don't have transparency on the internal treasuries, at least, what people are making their decisions on is what they do have transparency to, which are actually the DeFi positions, right? So, as much as I don't have a look into their books, I can look with everyone else at the smart contract and understand, what their, what the volume of of their debt position and also the liquidation price. And so if you have this average liquidation price and, you're trying to, essentially, take down this institution because you have a bet one way or another, then, it tells you how much you have to push the price in the spot markets, in the derivatives markets. So if you lower the liquidation price to, say Ethereum at 1K, then you need to push it to 999, right? So you have this on-chain transparency that's quite different. So as far as the risk taking, all I can speak to is, what we see in the DeFi wallets, right? And it's a lot of exposure. And even let's say if we take the locking of staked ETH, then that you don't have access to this right now, or if you do, you have to take it at a discount. This is why, the staked ETH is trading below liquid ETH right now, which can also be an interesting counter trade. If you're bullish on Ethereum and you're bullish on the emerge happening quick, then, it's also a good time to pick up discounted staked ETH.
Yeah, staked ETH would have to be worth less than ETH, right? Always, right? Because you're just...
Well, I mean, it has some, it has the rewards tied to it. So it should really be worth more. It should be getting around, I think, 12% per annum. But you're betting on, so the calculation you're doing is what can I get what yields can I get using my ETH today or in the next year, and what's the likelihood that this merge is going to happen? And so, for example, I had a choice to stake my ETH, and I kept them liquid because at that time you had so many different alternate opportunities to essentially get better than 12% per annum on ETH. So,
do you think the Ethereum 1 to 2 is the biggest news in crypto? I mean, not news. It's the biggest potential story that could affect things.
Yeah, it's going to be huge, but I mean, it's being pushed back and back and back. So and that's also causing more stress, right? And more, it's creating more risk, right? So, for example, in the case where you have a lot of staked ETH position, and you have client redemptions, you can't satisfy them because it's locked, right? Yeah. So that's why they're having to take the haircut on those positions. But for example, I like the proof of stake mechanism. Like I mentioned, I'm an advisor to Cardano, or I was an advisor to Cardano, which is a proof of stake chain. It's much more. You get different trade-offs, right? So it's much more efficient in terms of power. You don't have to have, the mining. You get different trade-offs in terms of openness, in terms of, it's better for security purposes. It's always easier. It's always less costly to get half the hashing power than it is to acquire half the network, right? You have different trade-offs.
Right.
But yeah, it should be. So I don't know all the implications, and this is something that I need to study, but I just don't have time. The new burning mechanism, I think it was EIP 1559, and the switch to proof of stake. So I'm not, to be honest, well versed in the whole monetary implications of it, but from an efficiency perspective, I think it makes sense.
Yeah, and going back to Celsius for a second, and just BlockFi and Nexo conceptually, the price of their token, banks don't have bank tokens, and you don't need a token to have this business model. Right, it's something that they added on as like basically an incentive mechanism to stake with them and to keep your money with them. You can earn. It's kind of a simple model. It's like you can earn 8% on your USDC, or you can earn 10% on your USDC if you want to get paid in Celsius coin. The Celsius coin, the plummet of that coin had seemingly been the red flag to a lot of people. Do you think it's just a combination of things that they're feeling internally, with Celsius coin dropping, potentially the staked ether that they have, and then I don't know if Luna would have negatively impacted them, and just the general market crash means that it's like kind of a structural challenge for all banking type companies when you give loans out. And people all come at the same time. This happened in the U.S. banking system in the 1930s, right? When the Great Depression, everyone was trying to liquidate, get their money out of the bank. The bank doesn't keep 100% of the assets in their account. They lend it out, which is the whole model of a bank. But it does mean that you're vulnerable to this kind of thing.
With over-collateralized lending, it shouldn't happen, because you should have higher collateral, than debt. So. Really, let's say I'll typecast it in the general. The more risk that you take, the more risk that you are exposed to, right? And that's really it, right? Yeah. So the more conservative companies, okay, so let's actually push this up to Luna, right? So Luna was promising 20% per annum on a stable coin, and no one asks how. I talked with my co-founder Dimitri. He looked at it and he said, "Hey, it's basis cash. It will never work." And it turned out that, Do Kwon was also the founder of Basis Cash, the pseudonymous founder, right? Which is just, you have two assets that are tied to each other. So, you have, like, for example, Ethereum, it derives its value from a whole number of things. It's, on-chain transactions. It's the demand for gas. It's the value of the assets on Ethereum. And then if you take debt against that for USD, USD has a different risk profile, right? They're not correlated, right? And Ethereum doesn't derive its value solely from being able to take debt against it. Whereas in the case of Terra, that was it, right? So you have this risk up, risk down, right? They're 100% correlated. One. And two, no one asked it, where do you get the yields from, right? So if you look at IPOR, actually, the IPOR rates right now are all sub 2. So if you look at, IPOR DAI, IPOR USDC, IPOR USDT, they're all sub 2%, which is, I think, you have the treasuries, which are outpacing the DeFi loans right now. right? But, it's maybe a more sober, sensible market. And the reason is, it's actually showing this rate is only set by, the cash borrows over the cash available. So it means that fewer people are taking loans against the amount of cash that's available to be borrowed. So if you look at the trends, you saw this DeFi yields dropping from like 100% per annum to 20% per annum to 12, and is now down to sub 2, right? So how are you getting 20%?
How did they claim that they got it?
I really don't know. To be honest, I didn't look too much into it. But I saw it rising in popularity. Had some of the guys on our team look into it and say, no, it's just this. It's this self-fulfilling prophecy until it unwinds, right?
My question is, why is that? You guys are very smart people spending your time adjacent to this market, adjacent to what they're doing. You're capable of assessing this project. You're capable of assessing it. There's so many people who have their money into this project that aren't capable. And a successful market works when a good percentage of people are doing diligence and assessing the market and effectively acting as a signal for unsophisticated investors. I don't think everyone coming in is going to do the equal amount of diligence on a project. Once a project reaches a critical mass, there's like perceptual risk mitigation. If it's like Tether, for instance, or USDC, it's like, I'm not going to go and audit Coinbase or go deep, but I trust that people will. And I think why did that mechanism, that trust hierarchy break down, do you think, on this project?
Well, so you had a few prominent people on crypto Twitter that were decrying it, and they were all getting attacked, right? In the end, they were vindicated. But the biggest thing is, you can't underestimate greed, right? So greed trumps, a lot of things, right? So we're a pretty, let's say we go back to IPOR, is a pretty conservative product because it's the IPOR rate is it's like a thermometer. It mirrors the sentiment in the room. So, for example, if the actual borrowing rates on Aave and Compound are low, then the IPOR rate is low. If it's high, it's high. It just shows that, and it bets against this actual rate movement on the markets. But what we're looking at is, in that borrower pays lender, right? So someone has to pay for that. Like all these like play to earn games. Well, you have to have a buyer, right? In gaming, right? If you have these tokens and you're selling them, someone has to be buying them, right? You always need to find a buyer. So look into the basic mechanisms, right? So in the 20% case, okay, so maybe it's okay, but you got to say, okay, so where's the 20% coming from? If it just comes from the token subsidies, then it is self-fulfilling until it's not, right? So actually, maybe I'll go into like why, for example, from the fundamental construction of, let's say, an IPOR interest rate swap, it's different from this, 20%, just out of the blue, right? So, it depends on how you construct an instrument. So simply put, let's say if you're a depositor in an IPOR pool, USDT, USDC, or DAI, right? Essentially, that's putting there to underwrite a contract. And you only get paid for that if someone takes a contract against you, right? So all the people that take a contract against them, they pay a fee to open that contract. And that fee goes back to the pool, right? So there's, your basic principle, startup 101. Someone pays for your service, right? The second one is that the AMM is designed to price the pool risk neutral. So it's winning as often as it's losing. There's a couple reasons for that. If you skew it too far towards the pool, then your traders get wrecked, and there's no reason to use the instrument. Also, if you don't price it right, then the spreads are too high, and someone's going to undercut the protocol, right? Someone's going to offer a better deal. But the key is managing risk to make sure that it's always kind of at this risk neutral, right? So there should maybe be a slight edge by the pool, but the pool, the pool winnings and earnings off of the instruments, should be marginal. So they're really making off those fees. And then while the funds are sitting there, but they're not being paid out, to the at the end of the contract, they go to Aave, they go to Compound to get this money market yield. So they're actually going back to the markets that they're underpinning because we know that there's some certain amount of debt being taken there, and someone's paying, to get access to those tokens, right? So there's always someone on the buy side of those to actually create this value. And, that's the simple fundamental construction. And that's, kind of what we miss. So this is why we did a deep dive into the TVL of the DeFi platforms at the end of 2020 and looked at, okay, so what has solid fundamentals? And most of them were just trying to, rehypothecate yield on yield, but a lot of those yields were just tied to token subsidies.
Interesting.
So token subsidies, like in, if you go to traditional startups, maybe you subsidize, like customer acquisition costs, or maybe you give someone like $50, $100 to sign up for an account. Okay, that's like a token subsidy, but at some point you have to find equilibrium.
Right.
So
exactly.
I mean, that's
you can be overcapitalized in the beginning. You just raise a massive round of funding. You give $100 to sign up. You boost your numbers, but a percentage of those have to come back and spend money on the platform, get value, and be willing to stay for some period of time in order to keep that flywheel going. Otherwise, flywheel goes off. Do you have a stance now on BlockFi, Nexo? I don't know if anyone else is big in that space, but do you feel like structurally there's value, long-term value that these companies offer? I know Celsius came out the day after and Nexo offered to buy Celsius the day after. Do you kind of look at the others and say, well, this is an individual Celsius problem, or do you think this is like a more broad industry problem?
Well, I look at that. I'm a bit more of a skeptic, so I look at that. I look at that as saying maybe it's a good marketing ploy, and maybe it's also a way to kind of push off their own transparency. I don't have any reason to actually use Nexo, so I think it's quite opportunistic. But they're also from what I know about them, they're less risk taking, right? So they have much more kind of solid risk management procedures. So, I think a lot of the, I don't think it's a systemic problem.
Yeah.
You have certain actors, you have certain, kind of risk levels. And, the other big news right now is, the potential insolvency of Three Arrows, which at one time was, I think, estimated to be about $5 billion. Right. But, it depends on your risk procedures are, everyone's a genius in a bull market. And you really found out, when everything goes to hell, then you find out, how your risk management procedures are actually. Right. So, this is kind of the shakeout that's revealing these things.
It's pretty wild. I mean, these things have to have ripple effects. It's like a massive multi-billion-dollar project or a company with over 1.5 million users doesn't just go down and then that's it. So I imagine at a minimum, people are scared and they move to maybe completely decentralized or more cold storage or out of crypto entirely. And at worst case scenario, there's overregulation, and then that stifles innovation for the rest of us.
Yeah, this is one of the issues, about this industry in general is it's not very good at self-regulating. You have a lot of cavalier people that actually, the better you do at self-regulating, the less, external regulation that you need, right? So, the more big problems that you have, the more so from collapses of several projects, it's going to be the Trojan horse to ride in, to put the stablecoin regulation. But, for example, I was around for the collapse of MT Gox, and we used to be the number 2 exchange to them. And for example, I knew, I knew them. We dealt with them on a kind of a daily basis, and there's a couple others, So in the early days, there was Gox, there was TradeHill, and actually BitInstant, Charlie Shrem was the first kind of it was a tool for arbitrators to go between Gox and TradeHill. And we knew from some of the, let's say, the delays in the payment, that they probably weren't whole. And, that was, very early on. And, Gox really, it really clipped a lot of big players, right? So you have a lot of big collapses, but these aren't necessarily tied to the technology. They're individual businesses in this space, So, crypto, for better or for worse, is that, everything is everything.
Yeah.
You know, DeFi is this token, which is this token, which is Bitcoin, which is bad for the environment, which is speculative, which is a Ponzi scheme, is everything. But, you know, it's like you're looking at there's actors that, you know, are rational. There's actors that are risk taking. There's actors that are fraudulent, and this is every market, right? So, you know, crypto as a space, it has kind of this, like, let's say you heap everything, or other people heap everything together and say, you know, it's all bad. But, you know, you really have to, you know, evaluate different projects, different tokens, different centralized lenders, different trading desks, different funds, and, you know, they all have, you know, differences, you know.
Yeah, it's hard to know, too. Like, who's to say, like, I mean, why would Celsius be an obvious mistake? Like, you know, millions of people thought otherwise, and we'll see how that story goes. It's like, it's tough to know. You know, that's where I'm like, as much as I hate government regulation in crypto, unless there's just a culture of, you know, there's always a equal and opposite reaction to every force. And when a company implodes or a project implodes, people learn, people make decisions. I think the industry gets more resilient. They'll certainly not make the same exact mistakes twice, hopefully, most people. And so projects maybe develop a culture of being more transparent, but then again, it always changes. I mean, yeah. Do you think more regulation would be helpful? More like government regulation in crypto would be helpful, or in some way would it be more helpful?
With regulation, you get clarity. And when you have regulation, you know, like, it depends, right? So if you look at some of the, okay, so for example, you know, IPOR Labs is a software builder in Switzerland. You know, Switzerland has, you know, the FINMA, right? In Singapore, you have MAS, right? You have single, like, you know, financial regulators, and they're very well versed, right? Whereas in the US, you have all these fragmented, you know, different regulations across different states, between different regulators. You have a huge kind of battle between the, you know, the CFTC and the SEC, and even, you know, let's say the OCC, if you're talking about stable coins, you know. And so kind of all this battle is, I don't know what's going to happen, right? So the SEC has been quite, you know, aggressive, going after, you know, a lot of, you know, essentially, you know, like a lot of the crypto scams, but using that maybe to expand the remit. Whereas, you know, the CFTC is looking to maybe, you know, get, you know, governance over a lot of the, really classifying a lot of the utility tokens as commodities. And we can see that in the proposed Senator Loomis bill. And, you know, it really depends on what form it takes, you know, but there's always this, this uncertainty, right? Yeah. And as an entrepreneur, you have to be okay with uncertainty, you know, like, you know, in 2011, there was nothing about this, you know, and there was no, you know, like, let's say even like on the personal tax, right, put out by the IRS, there was a notice in 2013, and then nothing, I believe, until 2018, right? So you have 5 years of uncertainty on how to report gains, for example. And so it really depends. It really depends on how open it is and how understanding it is, you know, to the actual technology, what the actual compliance is. You know, if you look at the bit license, you know this, I think it was Lasky, you know, who drafted the bit license. Kraken had an amazing blog post where it showed the Statue of Liberty with, I think, burning eyes or something, saying that they were leaving New York because it was, you know, it was too cumbersome and too, you know, to comply. And then in the end, you know, Lasky went around and turned, you know, and set up a consulting firm on how to get the bit license. So, you know, I mean, it really depends. But if you have a nimble regulator that understands, like crypto in general is like a genie you can't put back in the bottle, right? So if we go back to that first explanation, you know, peer-to-peer crypto anarchy, BitTorrent for money, like look at the BitTorrent example. It's the first like kind of decentralized application, right? So BitTorrent is it's no less problematic than let's say what was it, Napster. But Napster could be shut down because it was on a set of centralized servers, whereas BitTorrent cannot because it's a decentralized network. So now it's not to say that, for example, whether you say BitTorrent is good, whether you say BitTorrent is bad, or whether you're neutral, it doesn't matter to stop the technology because you can't put the genie back in the bottle, right? So it's more like understanding that from a regulator's point of view. You say, okay, so how do we deal with this? Mm-hmm. How do we deal with this? And then also, let's say the more aggressive you are, the more you'll have your best innovators pick up and move overseas. Because
that's the price you pay.
You kill the innovation, you rise the cost of compliance, and the compliance for what?
Yeah.
Right?
No, I know.
So it really depends.
I'm totally with you. I totally agree on the negative downsides of pushing people out. So we'll see, man. Well, keep being influential. I mean, while it feels overwhelming and disconnected and fragmented regulatory wise, send them tweets, or I think players like you who are wise and experienced and sophisticated matter a lot. And I don't know to what extent you guys are engaged with the regulatory guidance, but whatever you're doing, keep doing it and do more of it. Help us not cripple ourselves as a country. Darren, this has been a lot of fun, man. I wish you guys the best on the launch into the mainnet and thereafter. So hope to have you back on one day.
All right. Thanks, Mike.
All right. Cheers.